Hello, chart watchers, and welcome to this Friday, July 26th, 2019 Market Watchers live show with your host, Tom Bowley and Mary Ellen McGonigal. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Taking a look at the market action as we close out the week. Dow Jones Industrial Average currently up 42 points. The S&P 500 up 20, trying to make another breakout to an all-time high. The NASDAQ doing the same, up 88 points to 83.27. And the Russell 2000 up 12 points, still trying to break above its July high. 10-year Treasury yield did hit 2.10% earlier. It's back off, but currently flat, 2.07%. Volatility index on the move lower. It is down 5% today, getting ready to bust through 12 to the downside. This is the type of volatility behavior that we see during solid bull market advances. Communication services getting a huge lift today from several internet stocks. Big move here. This is a huge breakout that covers resistance over the past 2 years. Communication services breaking out will add to the bullishness of this market advance. Consumer staples also rallying today, still below the highs set a little over a week ago, but nonetheless, nice bounce off that 20-day moving average. Financials also having a very strong day, continuing to push to new highs. And energy lagging again. We are holding on to gap support that was established a little over a month ago, but overall, really just a lot of sideways action in energy over the past 5 weeks. Internet stocks, talked about that just a minute ago. Check out the huge gap higher. One of the big reasons, you can see Google up 120 points today. This is a stock that had not been looking very good on its chart on a relative basis or on an absolute basis, but completely befuddled Wall Street, came out with a great earnings report after the bell last night. You can see the big reward there. Restaurants also having a huge day today thanks to Starbucks. Starbucks coming out with its earnings report up more than 7% today. This is one we have talked about recently that has shown tremendous relative strength in a very strong area of the market, and we are now seeing why based on their beat on top and bottom line, their raised guidance. And then finally, you can see Intel. They came out with earnings. They gapped up. They were actually trading quite a bit higher after hours last night, but they have turned negative. Intel has not been one of the best performers in the semiconductor space, but they did have a pretty nice report, I think, adding to recent strength in the semis. But so far today, Intel reversing back down. All right, Mary Ellen, first of all, it's Friday. Welcome back. This is your day.
Happy Friday.
Yeah, I always love to see you because it's Friday.
That's right. There's got to be other reasons, Tom.
Well, I love to see you for many reasons, but you know it's Friday when you show up, so that never hurts, right?
Absolutely, yeah. And boy, what a happy Friday. The markets are just supercharged today.
Yeah, the markets are doing well. We're capping off relative strength week this week, and Dave Keller, I want to tell you something. We've kind of set the table here for you. I'm going to give you a little baseball analogy. Mark Chaikin was in here on Monday. He was our leadoff hitter. Mm-hmm. And then Tuesday, of course, Aaron and I were doing relative strength, but we don't matter because we're always here. Then on Wednesday, we had Gaddis Rose come in, showing a lot of, the way he approaches relative strength. Yesterday, we had a little tandem going with Julius and Arthur. They were batting in the third spot. So
that cleanup today.
That leaves us the cleanup. The bases are loaded. What do you got for us?
As the Cleveland Indians we will provide a strong fourth batting position here. We'll do well, I think. We'll wrap it up nicely.
Well, I don't want to rub salt in the wound, but that's why I didn't want to use a football analogy for you.
We'll stick with baseball for now. That's totally fair.
I think the Browns are going to have a good year, though. We'll see. Anyhow, we are going to go into relative strength. Dave is here to wrap the week up. I mean, it's been a super week. I hope everybody's enjoyed it. If there's one thing I would say in technical analysis that most average investors don't pay enough attention to, I would say it's relative strength, because they see a stock that's going up and, you're talking about it over the water cooler and you just jump in without giving, any consideration to how that stock's performing relative to its peers or relative to a key benchmark. And so a lot of times you look at a stock and it looks pretty good on paper, but it's not been a great performer on a relative basis, and that can really come back to bite you later. So you want to pay close attention. So Dave is with us today. He's agreed to come on board. and wrap up relative strength week. Really looking forward to it, Dave. Glad that you're with us today.
All right.
We are going to get into it. And Mary Ellen?
Yeah, let's take a look at our upcoming schedule. Next week, Tom is going to share August seasonality. You will not want to miss that. And on the 30th ETF corner, we have Dave Nadig will be joining myself as well as the team, Tom and Aaron, and should be a great show there. And following that, Jake Bernstein is going to be on the show, and Roman Okay, Tom, I'm going to ask for help.
Bogomazov.
Very good. Yes, and he'll be sharing his insights on August 1st. But let's take a look at today. Of course, as you know, we are going to be closing out our relative strength week. And following that, we are going to be doing 10 in 10 as usual. So please get your ticker symbols if you haven't already shared those names you want us to take a look at. And we will be ending it with what's hot and what's not. So great show today.
All right, let's just jump into it then. We do have some key economic reports, actually one major economic report out this morning. It is the first reading of Q2 GDP, and it came in better than expected. I think this is actually a win-win. I wrote about this in my blog this morning because we are still stronger than expected, which is good, but we're down from the first quarter. I think this paves the way for the Fed to lower rates next week. I think we're going to see that. Of course, the ECB yesterday, President Mario Draghi came out and said that the ECB wants to contain inflation, definitely signaling that they're going to lower rates going forward. You're going to remain dovish. And I think when you got central bankers across the globe very dovish and you've got a GDP that's still positive, I think that's a really good combination for equity. So I think that's something that we should continue to keep in mind. That Q2 consumer spending, I put that on there because it came in better than expected, and that is really what carried GDP. That, along with government spending, they both rose and accounted for about a rise of maybe 3.7% in the GDP. So actually, all the other contributors actually detracted from GDP, which, again, I think paves the way for the Fed to lower rates next week. Looking at the 10-year Treasury yield, I've highlighted, and I've shown this chart before, but I'm highlighting it again. When you get this positive divergence, the yields were going lower, but I thought momentum was slowing. I was expecting maybe a 50-day test. We hadn't seen one of those since early May. We still haven't, although we're getting closer and closer. You can see also the PPO getting close to the center line. I think what happens to the 10-year Treasury yield from here is going to be a really big deal as far as U.S. equities go, the S&P 500. Historically, when the 10-year Treasury yield is in an uptrend, a confirmed uptrend, that normally coincides with a big move in the S&P 500 to the upside as well, because money is rotating from Treasuries into equity. So it's not just new money coming into the market, but you start to see a clear rotation between these two asset groups. And I think that's really important. So let's watch this area, because if the 10-year Treasury yield breaks out, I think that is going to add to the bullishness we've already seen in terms of some of these all-time highs. The earnings continue to pour in. I mean, we have had a number of big companies report. Last night was no different. Amazon, actually a little bit of a miss in terms of their earnings, a surprise, and they lowered their operating income in next quarter. So a little bit of a warning there from Amazon, unusual. But Google, which was, I have to say, Alphabet, I was not expecting this. I was not expecting this kind of an earnings blowout. I don't think Wall Street was as well. This was one of the worst performers in the internet space on a relative basis the past few months, and I did not see this one coming. But they raised their guidance. They blew out the revenues and the earnings, and Google having a really nice reaction today. We'll look at that chart in just a minute. And as you look down this list, really the only one on the list that you can see there, McDonald's falling a little short and Charter Communications coming up short. But really overall, the earnings last night, very good. And we got a lot of positive responses to those. Let's start with with Amazon's earnings and looking at their chart, see what's going on here. Amazon, as you can see, and I'll get a fresh update, make sure I have the latest here. Amazon is at the high of the day, which is good. And if there's one stock out there that gets a pass for missing estimates, it's probably Amazon. Great company. We know about their tremendous marketing capability, their revenue growth, earnings growth. So one disappointment and a pullback, you're going to see a lot of folks jumping in. That's what we're seeing today. Amazon back near its high of the day, down 26, but it was down another 23. It was down $50 a share earlier today. I still think remains in an uptrend. My biggest problem with Amazon is that you can see broadline retailers broke to a 52-week high 2 weeks ago. Amazon's nowhere near its relative leadership position. In fact, it's kind of in the middle of its relative strength to its peers over the past year. So Amazon's a great company. It's in a good area, but I think there are others actually that just look better than Amazon to me at this point. Google, can't stress enough how shocked I was at this one. Look at the relative strength on Google. We had topped on a relative basis back in December, and we have been moving lower. And when we came into this report, we were at a 52-week low. So I really did not expect a positive report out of Google. I think this shocked Wall Street. And as a result, look at the volume coming in today. This is a major game changer on Google. And if I pull up that internet space for just a second, you'll see that at the end of April, right here, we had the big gap down in the internet stocks. It was because Google's report was disappointing. If I go back to that Google chart, look at the end of April. See the huge gap down? That coincided with that gap down in the internet stocks. Now we're getting the big move up in Google, and look at the internet group. Huge move to the upside. False breakout so far. I think we're going to get it. I just don't know if we'll get it today. If we fail today, maybe look for a little bit of consolidation, but I do think internet goes higher from here, thanks not only to Google, but also to Twitter, Snap, and some of the others that have come out with much better than expected results. All right, let's keep moving here. How about Intel? Intel looked like it was going to get off to a much better start. I'm not a huge fan of Intel. I think there are other semis that continue to perform better. Here's Intel relative to the semi group. Yes, Intel's been going up, but look at what the semi group has been doing. It nearly got back up to its high at the end of April. Intel's nowhere near. So on a relative basis, I think we still have issues. Even with a blowout report, they easily cleared revenue estimates, earnings estimates, and they guided Q3 and fiscal year 19 revenues and earnings per share higher. And yet we are down today, 28 cents. It's got to get through $53. You can see we got some gap resistance there. And if it can't do it with the semis being as strong as they've been, you got to wonder when they're going to do it. I would continue to look elsewhere. I like AMD much better than Intel. Starbucks, loved this one heading into earnings. Great area of the market. Look at the restaurants outperforming the S&P 500. Starbucks outperforming the S&P, outperforming the restaurants. And why? Well, because they had an easy beat. Top line beat, bottom line beat. They raised their guidance, and you can see the market loving a little bit of Starbucks this morning. VeriSign came out. They missed slightly on their revenues, and they did beat bottom line. Stock just kind of hovering here. Not a great report. We're starting to see a little relative deterioration in the stock. So I'd be careful maybe if we lose this 205 level down here. That's a recent support level. It also would be below the 50-day moving average. A couple that came out this morning. Let's start with McDonald's. McDonald's did match top line estimates. They missed on their bottom line. Stock gapped up anyway, but it is struggling to keep those gains. We're up $1. We're up, maybe about $4 earlier. Charter Communications missed on the top line, came up well short on the bottom line. This is one on a relative basis turning back down. I don't know. I mean, the hollow candle is nice, but if we fail today and we start moving back down toward the lows of the day later this afternoon, I would view that very negatively. I'd be careful here with Charter. A couple of others I want to mention very quickly. Team Atlassian, big breakout. It is in the software group. It's been a leader. They beat on the top line, beat on the bottom line, raised their Q1 earnings per share higher. Deckers Outdoor, this is a footwear company that had been one of the leaders here. You can see footwear moving up, but look at, we're up near a 52-week high on a relative basis to footwear. Well, Deckers beat top and bottom line, but they guided their Q2 revenues and earnings per share lower, their fiscal year 20 earnings per share lower as well. Let's see if we rebound. I actually think this one could, they're setting their bar lower for the rest of the year. They did beat. They have a history of beating. So I'm thinking this could be an opportunity, even though the stock's getting hit on big volume. Let's see if this reverses back a little bit more by the end of the day. And then finally, I wanted to go into the dashboard and show you ENVA. This is Innova International having a huge day today. And I just wanted to point out this huge jump in the scooter is coinciding with a nice breakout on the stock. And also, look at that volume expanding today. It's going to be a big, big volume day for the company. And it's in a really strong area of the market. It has just been an underperformer. So I'm watching a key relative strength line here. We had relative bottoms go in back in December and then again in March. After we broke below that, you can see we tried to get back through that relative resistance, couldn't do it. Here we come again. We're getting a breakout. If we can break out on a relative basis, I think it's in a strong group. This is one maybe to keep your eyes on, maybe keep on your radar. But for that reason, it is my scooter mover of the day.
All righty, let's go ahead and get started. We're going to go in now to upgrades and downgrades. And I think pretty quickly you're going to see a theme here as far as those stocks that have been upgraded versus those that have been downgraded. This first name that we are looking at here is Ambev, ABEV. It's the South American arm of Budweiser. And you can see, here we are. The stock gapped up quite nicely on earnings, and analysts are revising estimates higher on that gap up. Take a look at this volume. Institutions want in. The stock has broken out of a nice 4-month base. RSI and MACD are positive. We can take a look. A couple of bank stocks were upgraded today, and these guys are coming in with some good numbers. This is Bank of America, BAC. We can see another stock that is breaking out. Nice pickup here on the volume. We can see that the RSI and your MACD, very constructive. It's wonderful to see these bank stocks finally starting to participate in this nice, strong rally. Citigroup was also upgraded, not as much of a pronounced response. The stock is in a bit of a tight trading range here, does not look as bullish or certainly as constructive. We can look at trying to see if we had another bank stock. Goldman Sachs could be in that category as well. Goldman is another one that does look quite a bit more constructive. We can see the stocks finding support at this upward trending 10-day simple moving average. The stock broke out of this flat base here back in the beginning of July and is continuing to advance. You're not seeing a big pop today, but there is a $260 price target on the stock. It's at $220 now. Take a look at a couple of other upgrades, and a lot of these, what you're going to see are on these upgrades are companies that have reported strong earnings, and analysts are digging in, looking closer at these companies. And this WWE is one of these names. They did come in with good numbers. You can see this gap up. The stock is not constructive looking. However, this downtrend has not reversed. We're not seeing a break back above this 200-day simple moving average. Would need to see that. And one other name on the upgrade side is a small pharma, West Pharmaceuticals, all about the earnings. Take a look at this gap up. Stock breaks out of this nice base, and the huge advance following that uptick there as the stock continues to advance. It's certainly extended. We can see it's up there in that overbought territory. Let's go ahead and move on to some of these downgrades, and these are primarily going to be earnings driven. This is Borg-Warner, came out with numbers yesterday. The stock is downgraded, dropping down again today. So we're in kind of a bit of a dicey period here, but the stock is finding buyers on the dip, and it is now above that 50-day simple moving average in a constructive fashion. We can take a look at another earnings related downgrade. This is Dow Chemical. Take a look at this. The company came out with numbers yesterday, and the stock is also finding buyers. So really, on a day similar to today, you just can't go wrong. We can take a look at one other name that did get downgraded, and it's one of those big airline stocks that's renowned for their low cost. However, they may be pricing themselves out of business. This is Spirit Airlines, SAVE. Take a look at this gap down. They came out with numbers yesterday. Operating expenses had increased. Their numbers were poor, huge volume. Analysts are downgrading the stock. And that's it for upgrades and downgrades. We will be right back with Dave Keller.
1.
Okay, welcome back, everybody. And it is time now to bring David Keller in. Dave, as I mentioned, you are wrapping up Relative Strength Week, and I am looking at your first slide. And I realize we need to give you a little more time to prepare.
Well, I'm a very much as much as I love using stock charts and other advanced technology, pen and paper, it continues to be my main where I do a lot of my thinking. And it's so funny. A lot of times I end up looking at my notes, and that's where I find some of my best ideas have come from. So I went with the old school way of writing it out and then taking a picture with my cell phone. So sorry for that.
Hey, well, they do say keep it simple. Keep it simple, stupid, the KISS theory. And I think you've got it to a T right here. I mean, this is very simple, very easy to comprehend. I know exactly where the arrows are going. So, all right. Thanks for the presentation. I hope you have a great weekend.
I think that's it. Yeah, I'm done. Wow. No, listen, it's great to join you guys. And I've been really happy following Relative Strength Week this week. It's such a good topic to address, and I feel like a lot of, especially individual investors, don't put enough of their attention to what I would argue is the most important thing you should be looking at as an equity investor. Because what relative strength does is it very simply tells you whether you're getting it done or not as a stock picker. And if you're owning stocks where the relative strength is going down, you're flat out not getting it done. And the chart itself is the ultimate report card. That tells you how well you're doing based on whether that relative line is going up or down. And so I've found, and we'll talk in a little bit about the ways that I think of relative strength in 3 different ways, the 3 uses of it. But just to start and frame it out, this is a graphic that Alan Shaw actually shared with me years ago. And for those of you that don't know, Alan Shaw is a legendary technical analyst. He ran the group at Smith Barney that later became Citigroup and mentored people like Luis Yamada, who are exceptionally good analysts as well. But he actually came up with this idea. This is the way he demonstrated the importance of relative strength work. And if you think about it, as an equity investor, I would argue you have sort of 3 things to consider. The overall market environment, right? Is it the market environment where you'd want to own stocks or not? It's the groups or the sectors within that market, what's working and what isn't. And then it's the individual stocks. And remember, it's not a stock market, it's a market of stocks. It's a market of individual names that as a collective group form the market itself. So if you skip any one of those 3, I think you're hurting yourselves. And I find a lot of people focus just on the market and they think, all right, the market is good or bad or bullish or bearish. And then you start doing things as a result. And if you miss the rest of it, there's 3 parts to this for a reason. And if you think about what the arrows are telling you, if you're going to skip one of those, skip the market, right? If you're going to eliminate one of these 3, focus on the groups, focus on the sectors that are working and what isn't, and then focus on the individual stocks that are working and they aren't. Because if you think of your positioning from more of a bottom-up perspective that way, your market call will automatically emerge from all of the work that you're doing with the sectors and with the stocks. So, and again, it's not to say that you shouldn't look at a chart of the S&P 500. I do that every day as well. But the idea is to make sure that you focus enough of your time on the sectors, on the groups, and then on the individual stocks that are moving. And that's what's going to tell you the health of the overall market. So, this idea here where the groups and the stocks are interrelated, they form up to give the market itself. Now, why do I look at relative strength? A couple quick reasons, and hopefully for those of you that follow MarketWatchers Live, you've seen other guests probably tell you a lot of the same ideas. If you look at what academia has supported, if you look at academic research on stock movements and what works and what doesn't, one of the first really good academic papers on relative strength or on stock market performance was by Robert Levy. This was in maybe the 1960s. And Charlie Kirkpatrick, in a number of his books, has referred back to this as a seminal work on relative strength. It really talked about the value of owning stocks that were outperforming and not owning stocks that are underperforming. And if you look at any institutional quantitative models, and most institutions have a pretty good quantitative department at this point, 100% of them, if not 99.9% of them, incorporate some sort of momentum factor, and that is all essentially relative strength. It's owning stocks that are working and doing some sort of percentile ranking and tilting more towards what's working over what isn't. So long story short is all institutions that I've ever worked with incorporate relative strength in some part of their thinking. As individuals, I find this is where people should be doing much more than they are. And hopefully in the time we have together, I can demonstrate some of the ways that I would expect you to use it. It's a good time to mention we came up with a poll question, and on the screen, hopefully you have access to the poll. Just trying to understand which ways that you think of relative strength, and there's a lot of different ways you can look at it that we'll talk about in a moment. But you can look at the stock versus the S&P 500 as a broad market benchmark. You could look at the stock versus some other benchmark, like a broad market, like a Vanguard Total Market Index or a small cap index or something. You could also look at stocks versus their sector, industries versus their sectors, all these different combinations. So I'd love if you went in and just indicate which ones you regularly look at. And then later we'll look at that together and see if there's any indication, something we want to talk about from there. So a quick discussion, just how I think about relative strength and why I think it's important. And then we'll get to the three ways that I've used it. This is a chart of Pepsi, and this is just one of the best examples of the importance of relative strength. This is Pepsi from sort of early 2004 to 2008. So if you know your market history, this was sort of the bull market coming out of the 2002, 2003 lows, rallied up to the peak in 2007, then we sold off into 08 and 09. So this is sort of the middle, the meat of that period. So the question as an individual investor, if you bought Pepsi over here around 33, and then you sold Pepsi over here around 50, would you be happy with that? And probably you would be, right? You bought a stock over a couple of years, went from 33 up to 50. That's a pretty decent gain. You made plenty of money. You probably feel very good. Here's the kicker, though. If you look at the relative strength line, so this is Pepsi relative to the rest of the market, you'll notice that for pretty much that entire period that I just mentioned, you were flat on a relative basis, meaning even though Pepsi went up from 33 to 50, pretty much everything was doing something kind of similar to that, right? You could have just bought the spiders or bought a broad market index, a mutual fund, gone to the beach for a couple of years and would have done pretty much the same with your money. So a lot of times as investors, we pat ourselves on the back for good stock picking, when in reality, it's just market exposure that you're getting. And you're just getting one of the many stocks that gives you that exposure. So on the institutional side, which is a lot of my background, you'd always talk about beta versus alpha. And beta is just a shorthand of saying the overall market. And alpha is your ability to generate returns above and beyond what the market gives you. So alpha is your outperformance or potentially your underperformance of that beta, of that broad market exposure. So you'll find that even though Pepsi appreciated over that period, that's essentially market exposure that you were gaining. You really weren't gaining much above the market. However, that changed very much in 2007. So if you look, the price continues pretty much unabated, a continuous pattern of higher highs and higher lows. But look at how the relative line just skyrockets sort of in the second half of 2007. Again, think about the chart of the S&P 500. It's actually doing this. It's actually rolling over at that point. Market peaks in early mid-2007, rolls over. Big blue chip names like Pepsi, more conservative staples types of stocks, were the ones that did well in the second half of 2007, while a lot of stocks were actually selling off. So as an individual investor, recognizing the difference from this period where Pepsi was appreciating, but that was a market performer, versus here where Pepsi was appreciating and that was a huge source of outperformance, that's the difference between being a good equity investor and a mediocre equity investor, in my opinion. So the key here, the takeaway, is to look at relative strength. It should be a part of your toolkit. And again, I hope the other presenters this week have sort of shown why that's the case. What I'd like to do here is talk about the three ways that I find relative strength to be important. I think of it in three different ways. One is as an indicator. So relative strength should be an input into your process. It should tell you when stocks are outperforming, when they're underperforming. And in general, owning stocks that are outperforming, broadly speaking, all else being equal, is going to serve you better. You're going to do better if you own stocks that are working versus stocks that are not working. And that's what the data will support over many, many years, many, many cycles. So using it as an indicator is the first thing. The second one is to use it as a scorecard. So again, if you look at the charts of the stocks that you own, and I have a chart list with my current positions or recommendations, and you can actually see, is the relative strength improving on the names that I own or the names that I like here? And that is your report card. That tells you whether or not you are picking the stocks that are generating value above and beyond the overall market environment. So the second thing is as a scorecard. The third thing is as a market barometer. And I look at a lot of ratios, and I talk about it on my blog pretty regularly, looking at the relative performance of semiconductors as a good indicator of overall market performance, consumer discretionary versus consumer staples, these small cap versus large cap. These are essentially all ways of applying relative strength for a broader purpose, trying to understand market strength and weakness based on what groups, what sectors, what stocks are outperforming or underperforming one another. And I challenge you all to think about each of those three ways. And I bet there's one or two of those which you probably could be spending a little more time on. So what I'd like to do is just go through some examples of each of those and hopefully just jog your thinking in terms of how you might be able to apply in your own process. So there are a lot of ways to look at relative strength on stock charts. This is a chart that Gaddis Rose shared with me when I was first getting started. And this is a chart style I think most of you, if not all of you, can access. But what I like about it is the fact that the top half is purely based on relative strength. And a lot of times, it's very important. I'm not going to look a lot at individual stock patterns and price patterns in this discussion, but it's something I look at all the time. But I think it's really helpful to look at just the relative strength separate from that and just think about the relative performance on its own, because that's where, again, the value is really going to be added here. So this is Apple, and just to orient you, here we're looking at Apple versus the overall market in the top. The next one down is the tech sector, so the sector that Apple is in and how that's performing relative to the overall market. Below that, we have computer hardware versus technology. So what is Apple's group doing versus the rest of the sector? And then finally, we have Apple versus the other names within the group. So with those four lines, you can get a very clear picture of how Apple is doing relative to other stocks in its group, in its sector versus the overall market, and also some color in terms of where the returns are in the broader market environment. And by looking at each of those, you'll be able to answer the question very well. So a very clear-cut version of this is toward the end of 2018. This is going into the market low in December, and Apple sold off on a relative basis into the new year, into January actually. Didn't start to recover until February or March. But here we can see the relative strength going down, meaning Apple's underperforming the market. Tech sector is underperforming the total market environment. This is one of the many sort of broad market signals that were pretty concerning going into the December lows, was the underperformance of tech. Then we can see that hardware is actually underperforming the rest of technology, so it's not even in a good group. And then within that group, it wasn't even one of the better hardware names. Apple's actually underperforming all of those. What's happened now, though, is if you look at the 6, 7, 8 months afterwards, we can see now Apple stabilized and starting to outperform, although that's come down a little bit, really rallied in the first quarter and then sort of had the sell-off in April into May, and that's what we've now recovered from. But if you look at tech versus the overall market, technology has essentially remained strong for that period. So tech has been leadership, and it's remained so. Down here at the bottom, we can see within computer hardware, Apple hasn't been a bad name. It's actually been one of the better names within that group. But this is really the most concerning line you can look at. So if you want technology exposure, if you're looking for a group within there to lead and to help you outperform, computer hardware has not been it. And that's where this pink line is really, really important. So if you ignore that, you basically ignore the fact that there are other parts within technology that have been better than Apple. And just owning Apple and sitting back and relaxing really isn't helping you a whole lot, because there are other places within technology that have had different return profiles. And a great just illustration of how that might be different is by looking at Microsoft. So here we have a much different picture. Here we can see that Microsoft obviously has been a great performer on a relative basis for the last 2 years, generated a lot of outperformance. This line is the same from the previous chart, just looking at tech relative to the overall market. But look at how different this line is here. This is the outperformance of the software space within technology versus the hardware space. Then finally, at the bottom, we can see that Microsoft's been one of the better software names, especially in the last 4 or 5 months. After the market bottom, after the initial moves out of the December lows, Microsoft has really emerged as being one of the better names in the space. And here we can look on a price basis, higher highs, higher lows. It's a good chart all around. So understanding the difference in the two lines here, the outperformance of the group versus the underperformance of Apple's group, I think looking at that sort of input and thinking of that, what it means for owning one of these names, I would argue is one of the better things you can do as an equity investor. It's sort of that second level below just the price chart that's going to help you get a clearer picture of where the returns essentially have come from.
Hey, Dave.
Yeah.
I got a question for you. I mean, you were just pointing out Microsoft there, and it brings up a really interesting question. software has clearly been one of the best areas in the market from an industry perspective, and within technology, it has been the clear leader. And this goes back the last couple of years. At what point, and I'm a big fan of software, and I'm trying to find leaders, and there's a ton of them out there. Microsoft's certainly one of them. At what point, though, when you start to see relative weakness in a group, I mean, when a group leads like software has for a while, inevitably there's going to be some profit taking. You're going to see money rotate for a brief period of time anyway. Do you have a set level in terms of relative strength where it becomes more concerning? Let's say software begins to decline relative to the S&P 500. And I'm asking you this from my own perspective too, because it's something that it's more difficult sometimes to quantify than an individual stock where you can see a major price support level and so forth. Do you use relative support levels, or how do you approach that?
It's a really good question, and it's a fantastic question. And two ways I would say that I think about it. And the one is how the relative relates to the price itself. And the second one would be some sort of systematic way of looking at the breakdown in relative strength. How can you quantify it? So on the first one, I would say in general, a good chart, the best chart is up and to the right, and the relative strength is improving, meaning a good price chart and the relative strength is going up. And, talking with you guys ahead of time and looking at, just thinking about what the average chart looks like. The average chart on the S&P 500 looks pretty good right now, right? There are a couple that look, kind of bad, but not much, right? The average chart actually looks pretty good. So the only way you can differentiate between the really, really good ones that you want to own here and the ones that are just kind of going up but not really adding a lot of value is with relative strength. So a lot of charts see the price going up and to the right. The relative strength filter and looking for a divergence of higher highs in price, lower highs in the relative strength, I think is really, really key, because that divergence tells you out of all the stocks that are going higher, which ones are not pushing it up enough to justify owning it over other stocks. So a divergence is the first thing. The second thing is, I think there are ways to more systematically look at relative strength. And the one that I commonly look at is I look for a 13-week breakdown in the relative strength line. So a new relative strength low, a relative strength line that's lower than the previous 13 weeks, in my opinion, tells you that there's enough of a rollover on a relative basis that it should at the very least pop onto your radar. So that's something I routinely screen for. Stocks are making new relative lows, and 13 weeks is just something I found is early enough in the breakdown. You're going to catch things. If you look for like a 52-week low, a lot of carnage can happen before that. That might come up on there, but something like a 13-week relative low isn't necessarily an automatic get out of the way, but it definitely should pop it up on your radar. That's what goes on a watch list for me that I start reviewing more regularly. Does that make sense?
Yes, and right there. I'm sorry, Marilyn. 1 second.
No, go ahead.
If you type in Amazon there and instead of Microsoft, I'm just wondering if that's one of the divergences that maybe you might be a little concerned with. That pink line where you're seeing.
Yeah, this is a really, really good example. And I would say, when you're thinking of divergences, one of the common things you look at is when the price is making new highs, but then that outperformance isn't, or that up move isn't confirmed by the relative strength line, right? So, you have higher highs in the price, but lower highs or not higher highs in the relative. Just tells you that even though it's breaking out, a lot of things are breaking out, and you're not in the strongest part of the market. And the most concerning thing on the Amazon chart, in my opinion, would be here looking at Amazon versus some of the other retailers that you could have exposure to. That breakdown in that relative line just tells you that there are other names within that space that might continue to strengthen, while Amazon's a little weaker in the last couple of weeks.
Okay, appreciate it.
Yeah, and I was just going to take you back to software for a second. That's an area that I'm certainly involved in as well. And there are going to be periods where you'll see the group. Do you ever pay attention to ETFs like IGV, so that if that software stock is hitting a relative strength low, however, the broader indexes for software are also deteriorating? Does that play in at all?
Absolutely. And again, I mean, for me, I think of the market as a series of levers that you can pull, and thinking of and again, going back to the triangle that I showed you, right? It sort of fits into that. Thinking of the broad market and what configuration you're in. So right now it's undeniable markets at or near all-time highs. Overall, any trend following device is positive. So it's an environment when you'd expect to want to own stocks versus not own them. But the question all comes down to the groups versus the individual names. And I think you're hitting on a really good point, Mary Ellen, which is, thinking of, looking at ETFs. And so the other, I look at a lot of individual names, but also screen on ETFs making new 13-week highs and lows. And it's for that reason, understanding when there's a group rotation, especially on a relative basis, that if you're just looking at the chart and looking at the price itself, it's not going to seem as positive or negative as if you're looking at the relative strength line, because that tells you more where the institutions are rotating to. So screening is one way. And then, to be honest, it's the RRGs that I'll look at as well. So I'll look at a lot of groups, a lot of ETFs on the RRG charts, and just looking for where the rotations are. Because, again, a lot of institutions will need to be fully invested just by their mandate. But seeing where they're rotating in and out is where you're going to find the differentiation that hopefully helps you identify the leading sectors, and not just the sectors that are, sort of on market performers or a little worse.
All right, I got a question for you, and this actually came from the room, Dave.
Yeah.
Yesterday, at the end of our show, Julius and Arthur and I went over technical scanning for relative strength. I mean, technically, you can't scan for relative strength, but there are ways around it using the scooter scores and so forth.
Yes.
Is there a way that you look for relative strength in the market? Is there a way you scan for it?
It's a really good question. And you hit on, I'd mentioned the second use for me as a scorecard. The scooter rankings are, again, it's not a pure relative strength read, but it is in some ways, because it's looking at price performance and it's in a percentile ranking, which means the strongest names are going to boil up to the top of that list and the weaker names are going to be at the bottom. So if you routinely review the scooter rankings, and this is just the report that I pulled off just moments ago, in general, you want to be owning the names that are at the top of this list and not owning the ones that are on the bottom, especially current positions. So routinely visiting this list and screening for stocks that are toward the top, or, you guys do a great job of highlighting big movers in scooter rankings. I think that's an exceptionally good idea, because that'll catch things earlier on in the move, not things that are, at the peak, things that are just starting to emerge and improving in that price, which is going to generate outperformance. That's what's going to work more than the average stock. So I think improvements in scooter rankings on my dashboard page, that's one of the things I always look at are the big movers in scooter rankings, because I think a lot of times that's where you find emerging names versus others. The second thing I would say is just a pure price breakout. So I'll do 13-week highs and lows just in price. And again, in general, the stocks that are breaking to new 13-week highs tend to be outperforming, unless unless everything's breaking out. That's going to capture the names that are working. And again, 13-week breakdowns are going to be underperforming, broadly speaking. So that's the second way that I would start to do it. And then back to Mary Ellen's point, which is screening for ETFs. Even if you don't invest in ETFs, if you're more of a stock picker, screening for ETF movements, I think, are really good, because that's going to tell you what's moving. And then, the long answer to your question is I look at a lot of individual charts. So every weekend I screen through the S&P 500, and I literally, old school version, go through each one. And again, I think automating that process is great, and during the week that's really, really good. But for me, taking a step back and just looking at the charts and seeing where the relative strength lines are moving, it's very difficult to screen on divergences, for example, of price versus relative, but it will jump off of the chart for you. And John Mendelsohn, who's a legendary technical analyst and a mentor of mine, he always said, I like trends that you don't need your glasses to see. And so when you're screening through a bunch of charts, you want things that jump off the page for you. And I think for me, flipping through a bunch of charts, creating a chart list and just going through them over time, in my opinion, a lot of times some really good things emerge out of that. If you do it regularly, if you do it on a routine basis.
Another question that was in the room is, when do you buy on relative performance? So, all right, so let's say you've got cash available, you want to make a purchase, market's strong. Do you take a top-down approach?
Good question. So, for me, I kind of do a mix, and I've worked with investors that are top-down oriented, and they just look at the broad market and then either buy broad ETFs or buy stocks that they think will outperform if the market's going to outperform. So sort of the higher beta, smaller cap names tend to do well in a strong market, so that's where you do. I've also worked, especially in my time at Fidelity, a lot of pure bottom-up investors that if you ask them what is the market doing, they wouldn't be able to answer that question very well because they're just focusing on individual stocks, individual stories and themes, but they're able to build a portfolio that outperforms and that does well because good companies tend to be good stocks and so forth. For me, I've always valued a hybrid approach. So I like looking at the broad market. I like looking at a chart of the S&P. And in general, I use trend following tools. And you want to own stocks, in my opinion, when the market's doing well. Tom, you'd mentioned earlier when we were chatting, rising tide lifts all boats. And I think that's right. So generally speaking, you want to own stocks when the market's doing well. You want to not own them when it's doing poorly. But on the other hand, I think there are always, even when the market looks really bad, there will always be good charts out there. Always. I have literally never seen an environment where there aren't at least a couple stocks that are breaking out. And so it's always a question of screening and finding the pockets of the market that are going to do well and that are going to be differentiated from the rest of the market. So in my opinion, when is the right time to buy it? So in general, you want to buy stocks that are outperforming over things that are underperforming. And that's if your investment horizon is a couple weeks or beyond. I think in general, that's going to be what you want to do. Because shorter term timeframes, there's much more of a mean reversion and you can bet on the short term price swings. But if you're a longer term investor, which I would think a lot of people are on the listening today, you want to think broader and you want to be following the trends. You want to be owning what's working and not owning what's not working. So for me, in general, I want to own stocks with improving relative strength. And the perfect storm is something that has a long-term uptrend, has a long-term relative strength profile, but is pulled back in the short term. So it's pulled back to more of a viable point. I'd call that the fat pitch chart. Something you have to take a swing at. So a good long-term trend, a shorter, weaker short-term trend, that tends to be what works. So a strong relative strength line that's pulled back a little bit in the short term, in general, all else being equal, that's what I would sort of look for.
All right, Dave, that is why you are in the cleanup spot today. Because you are looking for the fat pitch. Grand slam. Right? Yeah. The grand slam. No, that was excellent. Excellent. All right, we've gone over a lot. You have more of your presentation. I didn't mean to cut you off. There were just some great questions coming in.
Yeah, no, that's fantastic. So just to review the three uses, so we've talked about it as an indicator. And again, a lot of times you think of relative strength as an input, and that's what we've talked about here. Also think of relative strength as an output of your process. It's also a scorecard. So if you want to measure your skill as a stock picker, look at the relative strength on the names that you've bought or the names that you own. The Scooter rankings are a great way to do that. So what I would suggest is at a regular period, whether it's the end of each quarter, end of each month, look at the stocks bubbling to the top of the Scooter rankings and ask yourself, am I owning those names? And if so, nice work. You're picking names that are really outperforming. If not, what on those charts did you miss, right? What happened, on Starbucks is a great example. This is a chart you mentioned early in the show. It's been just a great chart. It's been a great relative performer. Long-term relative strength profile is strong. The price movement is strong. What did you miss? At what point should that have emerged from your process, your stock picking process that you missed? And how can you start to get more names like this in your portfolio? So as a report card, I think it's really good. And then the third way I would just say is as a market barometer. So, look at the types of names that are working and roll that up. That goes back to the triangle. Think of the groups and the stocks that are working and roll that up to the overall market call. So for example, in a strong market, consumer discretionary stocks overall should be outperforming consumer staples. Generally speaking, that's how it's lined up because it's sort of an offense versus defense within the consumer space. So this was concerning in April and May when this line completely rolled over and all of a sudden you had staples names outperforming consumer discretionary. This is as the market's correcting a little bit. But if you look what's happened since then, this has gone back to improving where discretionary names outperforming staples. That's sort of a healthy market environment that should be encouraging. If and when this rolls over, that should be one of the market barometers, in my opinion, that should tell you, okay, hold on a second, are things really as healthy as they might seem? Another common one is looking at just the relative strength of semiconductors. So in general, the market can do well without semiconductors outperforming, but it's pretty rare, to be honest with you. This group tends to do well when the market's doing well, tends to underperform when it isn't. Again, this really outperformed in May, which was concerning. But look at how that relative strength reversed, and now it's almost back to new relative highs for the last year. So again, if this continues to improve that group, I think that tells you can be pretty comfortable with the market environment overall. But again, if groups like this start to roll over, you have to be concerned. So this is actually on, I have a chart list, a mindful investor chart list that I have, and a lot of these charts are actually on that chart list. And if you don't have access to that and you want to, just shoot me an email, davidk@stockcharts.com, and I'm happy to send you a link to that chart list to follow some of these ratios, these relative strength ratios that I think tell you a really good picture about the health under the hood, about the overall market environment. And that's it. Those are the three ways that I use relative strength. And again, I'd encourage you, if this isn't a part of your process, hopefully by the end of this week of hearing some of us share it, you've been convinced that it definitely should be.
Yeah. Well, excellent presentation. I do have one other question I wanted to go over, and I know this is an area that Mary Ellen has a lot of expertise in as well. But we were talking earlier before the show about a company like Lululemon, LULU. And the fact that when you look at the group, the clothing and accessories group, it's been such a bad performer or performing group relative to the overall market, relative to consumer discretionary. And that is a strong area, consumer discretionary. So it's a little concerning when you get a group within a strong sector that's not performing well. But what do you do with a stock like Lululemon that seems to ignore its overall group and continues to outperform on a relative basis, but the group is weak? I mean, how do you handle that?
So, for my take, again, I think it goes back to all the different levers that you can pull, right? So all that, for in this case, most of this chart looks really encouraging, right? Stock going to new highs consistently, trend following, it's above all the moving averages. That's all good. It's outperforming the overall market for the last, 12, almost 2 years here. Outperforming it's in a strong sector because it's outperforming, and even it's outperforming its group. But this is the one area of concern, which is to the question, right? Which is the fact that its group is not outperforming consumer discretionary. So all that tells you is I wouldn't feel bad owning this stock. And again, if my portfolio was a bunch of stocks like this, I wouldn't feel that bad about it. And overall, you're doing pretty well, and you're doing well on absolute and a relative basis. But all this pink line tells you is that you're leaving some of the best opportunities on the field, right? You're leaving them on the sidelines. Just to go back to my background, I spent a lot of my career evaluating analysts, professional analysts, stock picking and measuring their stock picking. And one of the traps we would fall into is just look at their buy recommendations or their overweights versus their sell recommendations or their underweights. And in general, that's not a bad way to measure an analyst's performance, right? If your buys are outperforming your sells, that's pretty good. And in general, you're doing okay. But that neutral line, or the stocks that weren't being addressed, weren't being covered, so all the neutral or the unrated stocks, that a lot of times was the most important group. Because, so for example, your buys could be doing pretty good, your sells could be underperforming, but the stocks you weren't rating were doing exceptionally well. And all that tells you is you're leaving the best opportunities on the sidelines. So for me, it speaks to the value of screening and always looking for stocks that are doing well and stocks that are doing poorly, and making sure that you're routinely gravitating to the names that are working. So what this would tell me is it's not, if I was currently holding it, not bad. I'd probably feel good about it. But I would be screening for other stocks within consumer discretionary, within other groups that might be having even a better performance profile, and those might be the ones you might want to rotate into.
And I will add, within consumer discretionary, this is a phenomenon that occurs again and again, where there are clear-cut pockets of strength that might not be industry group wide. So we have Lululemon. Some of the other names in there, BURL is picking up Burlington, Boot Barn, BOOT. These are all outperformers from the broader market's perspective. And if you go back, let's say a year ago, consumer discretionary, for some reason, it was all home furnishing stocks, Restoration Hardware, TJX. So while you'll see that maybe the broader industry group that it's a part of might be waffling, you'll get these pockets of strength. And Dave, you're right. It's going to be all about screening to get you in front of those names.
Yeah, and to your point, I think it also depends on the sector. So we're talking consumer discretionary, we're talking technology, pretty diverse sector. There's a lot of companies with very different business models if you think about everything in consumer. But if you look at energy, for example, you really only have a couple buckets of different companies and very much tied to oil. So you have the big integrateds, you've got, exploration, E&P stocks. And so you're going to get less signal, I would say, from that line looking at the groups, because the groups a lot of times will be very similar. There'll be a lot of high correlations there. Something like consumer discretionary, technology, even healthcare, there are very different types of stocks that make up that sector. So the relative within the sector becomes much more valuable.
Excellent. All right. Well, I tell you what, you did it. You did it, Dave. You hit the home run, grand slam. You emptied the bases, and you brought home Relative Strength Week. Great presentation. I think everybody enjoyed it. Some awesome questions in the room. So I think you were bringing up a lot of interest in things that what we should be looking at. So I think it's a good time to maybe take a look at that poll and see how everybody answered what they use relative strength for. With this being the last day of Relative Strength Week and having Dave here, wow. I mean, it looks like 76% use the stock versus the S&P 500, which that's exactly what I would have expected. I mean, I would have expected the benchmark S&P to be number one.
Yep, that's exactly right. And I would say that, that should be the first one. And if you're going to look at one, that's definitely the one. But I would say the ones that are further down this list, I wouldn't rule some of those out, because some of those are some of the better indications. And again, we've just been talking about industry group versus sector right here, and that's telling you how one part of consumer is doing versus the rest of consumer. Don't skip some of those other indications. And again, some of the chart styles, Tom, that you show routinely, I think, do a great job of illustrating all the different ways of slicing relative strength. So I would encourage all of you to experiment with how you set up your charts and make sure you're thinking of each of those, because there could be a theme that is happening that you won't pick up otherwise.
Yeah. Yeah, I think just about everybody that has been on Market Watchers Live, you included, Dave, everybody that was in this week, it's a big part of what we do in terms of managing our own portfolio or in our writings, teachings, and so forth. This becomes a really big part. And I hope that this week, the focus that we've had on Market Watchers Live this week in terms of relative strength has really helped a lot of folks out there, because I really think that this is one of the most important parts of technical analysis. I mean, finding breakouts, seeing price action, following negative divergences, looking at the momentum oscillators, all this stuff is part of technical analysis, but not understanding relative strength could be a really big problem in terms of portfolio performance. So I just want to thank you and everybody that's joined the show this week for your great contributions.
Absolutely. Cheers, you guys. Always a pleasure to join you. Thanks for doing the show.
Have a great weekend, Dave.
You too.
Next time, Dave, we're going to give you notice more than just 5 minutes before the show, so you can get maybe 2 sheets of paper ready for us.
No promises. And I will tell you, a lot of times I write these on paper on an airplane. So at this point, it was actually at my desk, so the lines were relatively clear and uncluttered. So no promises, but I'll do my best.
I like it. I think it's awesome. All right. Have a great weekend, Dave.
Yep. You too.
All right. Thanks. All right, Mary Ellen, it is time to jump into the 10 in 10. I have already got that one ready to go. So I am going to take a look. The first one today is Shake Shack, by the way. And so let's jump in here. All right. I like the stock. It is in the restaurant space. We talked about Starbucks and how strong this group is today and how strong it's been. Here is your absolute chart. But as we've been discussing all week, that's not good enough. We want to make sure that we're in a group that is outperforming. Look at restaurants versus the S&P 500. What this tells you, and when I look at this and I see a relative strength line like this, I see dollar signs moving into this group and moving out of something else. That's really what's going on. More money is rotating into restaurants to go towards these individual stocks. Not all of them will be great performers, but many will. And Shake Shack, I think, is one of the really strong performers. It's continued to trade above its 50-day moving average. It consolidates, it breaks out on a relative basis. It's been moving higher. Really is not a whole lot more to look for. I could argue that maybe Starbucks looks a little bit better, or we could have an argument maybe Chipotle might look a little bit better. But the point here is that you've got a stock that's outperforming. I think Shake Shack looks really, really good. Got no complaints.
Very good. Next one is software stocks in the security space, PANW.
All right, PANW, Palo Alto Networks. Yeah, you can see the group telecom equipment trying to make a breakout, and I'd make an argument you got a pretty nice little pattern here, either a cup and handle, or maybe we've got equal highs. Maybe we'll come down a little bit lower and establish a higher low to put an ascending triangle. But I think the group looks good when you look at it relative to the S&P 500. As long as we hold that May relative low, I'm okay. Stock, though, individually is starting to show some strength. I want to make sure that continues because we were in a 4-month relative slide on Palo Alto Networks. So when I see something like this, and this is the way I would approach it, I'm going to find a key area of price support. If I'm convinced that the stock's showing relative strength and that this group is still a good group to be in, then I want to look for some key areas. I know right here we had a gap down, came back up, tested it. We finally broke above that 215 level. And notice where the 20-day moving average is, right above that 215 area at what, 218 in that area. So that's a zone that I would watch the downside on Palo Alto Networks. I think you're in a good group. I think you're in an improving stock within the group. And so because I'm a little concerned about the recent relative weakness of the group, if that turns back down, I want to make sure I'm protected. So I would keep a stop maybe around 215, but otherwise, I think Palo Alto Networks looks really good here.
Very good. Next one is one of the few stocks that's not up this week. It's Tandem Diabetes Care, TNDM.
Yeah, when we get into the what's hot, we're going to focus on what's hot, not so much what's not. But yeah, I agree. Last 5 days, stock's been pulling back. I've been looking at this saying $60 is a level I think we need to watch. The relative strength has not been good. We actually just moved to about a 5-month low. So that tells me I need to be cautious. And the fact that we've got a key price support level that has been holding, I would make my stop right around the 60. I mean, if you wanted to go slightly lower, you could go 57.5. I think, we could sit there and, make all kinds of excuses and just keep drawing lines down the list here. But I think what I would do is probably keep a fairly tight stop because we are in a bull market. I don't want to be caught in a stock that just keeps trending lower. I really think this area right in here between about 58 and 60 needs to hold. You are in a good group. Medical equipment stocks just broke out. We may simply just be consolidating this massive gain that we saw at the beginning of the year. So I'm not ready to write the stock off, but I would keep my stop in play.
Very good. Next one's a big pharma that reported recently. It's Abbott, ABT, Abbott Labs.
Yeah, ABT. Then next, guess we could do Costco, Abbott and Costco. Is that kind of like Abbott and Costello? Sorry. Abbott's been a great performer relative to the pharma, so you got to like that. Pharmas have been coming down, and Abbott's breaking out. So that ought to tell you something right now. If money ever rotates into the pharmas, you've definitely got one of the leaders. So this gets back to a point I think you were talking about earlier, Mary Ellen, that there are pockets of strength even in weak areas. Mm-hmm. And Abbott Labs is definitely one of those stocks. Look at what pharmas have been doing relative to the S&P 500. And yet Abbott relative to the S&P 500 just went to a new high. So if I'm looking in the pharmas and I'm looking for a healthy stock, I'm probably not going to look a whole lot further than Abbott. I think you watch this gap support level down here. We had gap up, nice earnings, good push there. I think as long as we stay above 83, I think Abbott looks good.
Very good. Next one is a Chinese consumer lending stock. QD is the ticker.
QD. All right. All right. Yeah, I actually like this pattern. Now, this is interesting because the stock, first of all, it's in a really strong area of the market. I love the volume trends on this way up. So I think there are some really some good positives here. What I would look for is two things, and I don't mind holding this stock and waiting. I think that you've got some overhead relative resistance. You can see this has been a key area. If we can break out above that, I think that would be bullish. The other thing that I'm kind of watching here, and just to have a little patience here, I'm a little OCD with what the different colors and stuff I use for different things. But here you can see the equal highs coming across right there. And then you see these rising lows off of an uptrend. That's an ascending triangle. Great volume trends in here. I think you're going to break out. If you break out above 9, To me, that measures up to about 1075 or so. So I think the stock looks really good. It's in a bullish pattern, bullish group. You get the breakout, I think it confirms. So I like it.
Very good. Next one we touched on a bit earlier. It's Intel, of course, INTC.
Yeah, we took a look at that one. It's I'm going to show you on a relative basis. The big thing to take away on this stock, and I hope after this week of relative strength, everyone looks at their charts just a little bit different. And right here, this is my problem with Intel. It's not on their price chart. I mean, their price chart, you look at it, they're trending higher. They're above the 20-day moving average. They're going fine. Everything looks great. Well, a lot of that, though, is because the overall group is going higher. So it's, well, Dave and I were talking about earlier, the rising tide lifts all boats. Intel is just on the boat, and it's going higher because of the group. It's not going higher because of its own individual performance within the group. And that's where I have the problem with Intel. So, yes, it had a great report. It looked like it was breaking out. So far, reversing. Again, I stick with AMD. I think AMD is a better stock at this point. And if you look at AMD INTC, and you just look at that over the past couple of years, you'll see that AMD has been a much better choice. Until that changes, I would probably change out of Intel, and I'd stick with Advanced Micro Devices.
Very good. Next one is a gold stock. They're taking a breather this week. KL.
Yeah, I'm still not a big gold fan. I'm not sold. This is one of the best stocks within the space. If I was looking for something in this space, I think Kirkland would probably be it. I know Greg Schnell's been on the show. He's talked about it. It's been a great performer. And you look across and all of the lines are pointing in the right direction. So this one I would be okay with. The bigger problem I have is just the fact that gold on a relative basis to the S&P 500, I think is going to struggle until the dollar weakens considerably. And so I just would personally stay away from gold. But you can see here that Kirkland Lake has got some great support between about 40 and 44. We're trading above that, been trading above the 20-day. Can't really argue with this pick in the space.
Very good. Now, next we have an ETF, IAT, the regional banks.
Yeah, the banks are starting to show more strength, but it's always, again, on a relative basis. I want banks to perform well, and we're beginning to see that. We're getting participation from the banks. I think that's really important. We don't need to necessarily have leadership from the banks, but we need to have them performing well and moving higher. So if on a relative basis they're going down, but they're still moving up, I think that can be a good thing because we are a debt-driven society and our markets are based on growth through debt and leverage. And so IAT breaking out with a nice-looking PPO here, I think looks good. Now, does that mean I would buy it? Probably not. It probably means I just want to look for other areas of the market that are outperforming. So mixed signals here, but I'm bullish. I'm bullish the fact that regional banks here are breaking out.
All right. Next one, consumer staples, CLX. It's poised to break out of a really long base.
Yeah, Clorox has been a really good performer. It's in that consumer staples area. So if you're more interested in being somewhat defensive in this environment, I think this is a really good stock considering. I'm sorry, did you say something, Mary Ellen?
No, we're good.
Oh.
Yeah, I agree. It's been a real outperformer in that staples space.
Yeah, I mean, within the non-durables, you can see that it has been downtrending, but overall against the S&P, it's holding up. It pays a dividend. For the right group of investors, I think this is still a really nice play. The breakout here is coming above the highs that we saw back in November and December. And I'll just annotate that so you can see that a little bit more clearly. But we have not had an open or a close above that 164.75 area, something like that. And it looks like we're getting that today with this action. I'd like to see a little bit more volume, but it is performing pretty well. It's also trying to break out to about a 3-month relative high. So there's some positives. Not my cup of tea, but as far as somebody maybe looking for income and a stock that's beginning to show relative strength, may work out pretty well here.
Very good. Then we have another ETF stock, PSJ.
All right, PSJ, Dynamic Software. Well, I will tell you, I'm a big fan of the software group, so not familiar with this ETF and its holdings and so forth, but I'll just say software has been very strong. You can see right in here, You had a top here, you had another top here, a little sideways consolidation, uptrend, cup handle, breakout, come back down, test the breakout level, move back higher. I mean, there's nothing wrong here technically. I like it. PSJ looks good.
Very good. And I am checking. I apologize. I'm looking for that 10th stock. Let me just see.
Maybe I have it. Maybe. Nope. I think that is it. I think I misnumbered. So I think we're good. I think we got 10.
You bet.
And should come up on your screen, the 10 that we just went over. And there you have it. And we're going to take a quick break. But when we get back, we will go into our final market update. And then we'll do what's hot and, well, not so much what's not, mostly what's hot. Stick around. Okay, welcome back, everybody. I hope you have enjoyed our relative strength week. Speaking of relative strength, you can see the NASDAQ is outperforming today. So we've got relative strength in the NASDAQ up more than 1%. Relative weakness is in the Dow. The Dow Jones currently up just 0.06%. So we are seeing a little bit of lagging in the Dow. And when you look over here at the market movers, the top 10 in the Dow to the downside, you can see Dow down 3.5%, 3M down, a number of stocks down over 1%, including an energy stock. We got CVX, and then, of course, Caterpillar, which is struggling as well. So 4 of the Dow components there leading the Dow to the downside, holding it back, if you will. We flip over percentage up, and you can see Coca-Cola having a nice day, along with United Health, Procter & Gamble, and Verizon. So a very quick way to see what's working and what's not working in the market. I also wanted just to point your attention really quickly to the article that I wrote in Trading Places this morning, because one area that I'm really watching closely, I think I mentioned it earlier in the show, communication services, and the fact that we're trying to make this breakout above a multi-year price resistance level. We have been getting up to about this 5150 area on multiple occasions over the last year, and we have not been able to get through. If you click on the chart within the article, look at what's happening today with communication services. I mentioned if we could get a 2 to 2.5% move in communication services today, we would be getting a breakout. Right now, this group, on the backs of so many great earnings reports in the internet space, we are really skyrocketing here, up almost 3% today.
And of course, Google's a big part of that. Yep.
Yeah, Google's a big part. We've seen Twitter also this morning coming out with really good results. Snap recently. Snap's had a huge week this week. We'll talk about that a little bit in the What's Hot segment. But this is a big breakout here. And so now we're getting another part of the aggressive area of the market, moving to new all-time highs. I find this to be very, very bullish, and just another area of the market that's going to be looking for dollars to support this move to the upside. All right, it is time now to move into the What's Hot, What's Not. Mary Ellen, what do you have today? There's been a lot hot, but what do you have specifically?
Yeah, I'm thinking we could spend an hour on what's hot, but today we're going to be focusing on areas that are of interest that you can, by being aware of, take a closer look at. This is UPS. Company came out with earnings, but what I really wanted to point out to you are a couple of dynamics. And this is so that going forward, when you see these similar dynamics, you will pay attention. So this is the release of their earnings on Wednesday. Take a look at that gap up. So we have a couple of other characteristics occurring here. Huge volume, just unprecedented. You'd have to go back historically. You will not see that type of big volume. We did have positive RSI and MACD, but the stock also broke out of this 2-month base here. So what you can see, 2.5 months. So with 2-3 different dynamics occurring. The stock gapping up on positive earnings. The company also came out with new initiatives. They've started Sunday shipping and other accommodations for smaller businesses. So analysts like that, when you see this gap up, oftentimes when the volume is this significant, it will advance further because analysts are going to dig in. And indeed, we did see that UPS was upgraded today, up another 1.7%. I would argue right now it's a bit extended. But again, when you see those gaps up on huge volume, break out of a base, oftentimes you will see further advances. Let's take a look at FedEx. Now, FedEx is up this week as well, but take note because it's not nearly as dynamic. This stock is in a very confirmed downtrend. It's attempting to reverse that. We did have that shorter term 10-day up through the 50-day, and it is looking constructive, but we still have this longer term 200-day in a downtrend. Look for potential upside resistance at that 183 at that 200-day, but we do have a positive RSI and MACD, but again, not nearly as dynamic. This kind of move is oftentimes sympathetic because it is in the same industry group, but your clear winner is UPS. Another in the transport area, this is Echo. It's a global logistics company, and another one that is in a clear-cut downtrend, came out with strong numbers, but again, not looking very constructive. Let's move on to financials. We talked about some of these regional banks, but there are other vibrant areas within the financials. And this first one is Discover Credit Card. Take a look. This is another one. Big gap up, strong earnings, huge volume. Now, you're not seeing as much of an add-on. There is a secondary phenomenon that will oftentimes occur following these gaps up, and that is a sideways back and fill consolidation, in essence, digesting this big move up. You don't have to go too far back to see a similar period. End of April, gap up on numbers, back and fill as it digests. Then, of course, the stock got caught in that May downdraft that we saw, but a very explosive move there. We can take a look elsewhere in the financials because we're seeing a number of asset management firms pick up. It has everything to do with the bull market period. This is T. Rowe Price, and they're attributing their recent growth to the broader markets uptick that we've been seeing here. This is another one with that earnings. It had a very significant move up, which caused it to break out of this 3-week base. Again, another nice pickup in volume, and the stock is continuing to advance a bit further. We're seeing a pickup also in some of these brokerage type stocks such as E-Trade, ETFC. This one could be very interesting because we had this downtrend in line with the May deterioration in the broader markets. The stock has now broken up above all of these key simple moving averages. And from my work, that the stock now has more room to grow, if you will, or to advance higher. And we can see that the RSI and the MACD just turning positive here. So this could be interesting. We'll take a look at one other one in this space. Similar is Charles Schwab, another one that is attempting to reverse this downtrend. We're not quite out of the woods yet. I would like to see more volume on this upside push above that 200-day simple moving average. And one other area that we can very quickly take a look at, because a lot of these are going to be earnings related, but in healthcare, this is Edwards Life Science. EW is the ticker symbol. We can just take a quick look at that. They came out with very good numbers. Take a look at that gap up, huge move, big volume, but we're seeing that other phenomenon where the stock will potentially just be in a back and fill period. Again, we can go back historically to this March period, gap up on earnings, and the stock digested that, and then unfortunately that May deterioration came into play. But that's another area that is looking interesting. Tom, I know you have some areas that you'd like to hit on as well on the what's hot area.
Yeah, I'm going to just go back briefly to the communication services chart that I looked at. So we saw that breakout, but I also want to point out a couple of patterns here on the XLC. Here is a beautiful uptrend off that December low all the way to through the end of April. And then when the market was weak in May, we actually started forming a continuation pattern on the XLC. So there's a couple of different patterns you could look at. You could say, okay, this is a cup, not exactly perfectly rounded, but it does, have a left side, right side equal. So if you look at this as a cup and then a handle, we're getting a breakout. The other thing that you could look at is off of this uptrend. I use inverse head and shoulder patterns. I know other technicians don't, but I find that they're very, very useful. After the uptrend, I think what we have is kind of an upside down head and shoulder or an inverse. So we've got a pullback, left shoulder. Here's your neckline. Here's another push to the downside. Normally in a downtrend, you don't come all the way back up to this prior high. In this case, we did. We established a right shoulder that was above the left shoulder, the right side of the neckline, slightly above the left side. And then we broke out. And when we had this recent pullback, instead of looking at it as a handle, it could also just simply be a throwback or a back test of this breakout of the inverse head and shoulder. So depending on how you view this chart, I don't know how you really can look at it any other way but bullish based on these patterns. So for that reason, I think that it's really important to look at what's causing it. And there's no doubt in my mind what's causing it. It's the internet group. Internet trying to make this breakout above that April high. I think we've also got a very similar type pattern here on internet stocks. And now that Google's poor earnings report that we saw back in April is behind us, and now we got a really strong one behind us and or supporting us, along with Twitter, Snap, and some others, I think this is a group you want to watch. So just a couple of quick names in this space that we haven't already talked about today. Let's take a look at Snap and the chart. Look at the breakout with its earnings a couple of days ago. Check out the volume. It's hard to argue against a stock like this. And this is one of those examples where maybe a technician who's going strictly by the book says, wow, we have higher prices. And right now the PPO is lower. That's a negative divergence, slowing momentum. I find it very difficult to make that argument when you see this kind of volume supporting a breakout to a 52-week high. That to me is not a sign of slowing momentum. If anything, this is accelerating momentum. And so that's why, to me, price and resistance and support, all of that, the combination of price and volume trumps these other indicators like the PPOs and so forth. I think it's really important to understand what's going on here. Let's take a look at Pinterest. Wrong one. PINS is the correct symbol. Pins. And with pins, you can see it's been a strong week. Now, this one doesn't look nearly as strong as, say, Snap or many of the other internet stocks, but it has had a strong week. It's trying to get back through 28. I think if it could get through about 29.5 to 30, that would really be a good move for Pinterest. But until then, we just go with what we've got. And then finally, Netflix, the last one I have here. Yes, it's had a strong recovery this week, but it's got a lot of overhead resistance at 340. I'd still personally be careful with Netflix. I'm not sure the selling is quite done yet here. What else you got, Mary Ellen?
Yeah, so let's continue on with what's hot this week. And I think we would be remiss if we did not talk about some of these semiconductor stocks really on fire. This first one is Texas Instruments, and the stock's up 9% on the week. We can see this big gap up, and this is what I've been reviewing in a number of these other names where the volume is huge. That's telling you institutions want in. So let's go back historically. We can go back to, for instance, in January, we had another period. This is earnings related. This gap up, the stock advanced beyond that earnings report. But take a look, it just pulled back to that 10-day simple moving average. That was your buy point, and the stock continued to advance further. So you're going to want to look for that similar dynamic. This stock really pays attention to this 10-day simple moving average, which is your green line. One of two phenomena will happen. Either the stock will pull back to that 10-day simple moving average, or it will simply mark time until that 10-day catches up to it. So you want to keep an eye on that. Applied Materials is another stock that is up big this week. It's up about 6%, another semiconductor name. The stock is advancing. It's not earnings related, it's very much dynamics related. The semiconductor space has been in an uptrend. Goldman Sachs came out last week with an upgrade. The markets really embraced that. So another one where the stock has advanced significantly. It may mark time here for a while, digesting. Look for something of a pullback among these super strong semiconductors. Microchip is another one, MCHP, and we can see that gap up there. This particular move, again, is not quite earnings related, but we are seeing strength among these names. And take a look, the stock is poised to break out. If we can get up above that $100 level, we're at 98, that would be a nice significant break out of a 2.5 month base, which would be another bullish sign that you can add to that. So we can certainly take a quick look at one other area. We talked about financials. Some of these regional banks, I'm just going to point out a couple of them. Northern Trust, NTRS, this is all about earnings, but it is also breaking out of this nice long base, marking time, digesting this significant move that it's had for the week. So we could see it mark time, but it is in a very bullish position here. FITB is another one. These guys are all putting out very good earnings, and this particular stock did break out on that earnings release. We can see the big volume relative. It's all going to be relative. And the stock is continuing to advance outside of it, primarily because it has that dynamic that I mentioned where the stock is also breaking out when it's gapping up on that news. So we can leave it at that for what's hot. And next week, maybe what's not, but not this week.
Yeah, I agree. This is just not the week really to go over what's not. We've got all-time record highs in the Dow, the S&P, the NASDAQ. I guess if we did anything, we could say what's relatively not.
There you go.
And then we could focus maybe on the small cap Russell 2000. But yeah, it was. It's been quite a week, quite a run for the market, and I'm on record. Who knows whether I'll be right or wrong? I'll be one of those two probably. But I'm very bullish. I still believe the market goes significantly higher. I think there's so much money, not only on the sidelines, but also in other asset classes like treasuries. There's so much in terms of U.S. treasuries, foreign treasuries. The central bankers have been so dovish, and the money is out there. And I think eventually what we're going to see is economies start to pick up. I think we're still in a long-term bull market, secular bull market. And when we're in a secular bull market, the advances can be mind-boggling sometimes. And I think
I would be remiss if not pointing out next week we do have that Fed meeting taking place, and that potential interest rate reduction, that could be the only potential hiccup if the markets don't get what they are anticipating in the way of that. But certainly these positive responses to earnings is super bullish.
Yep. A couple things before we wrap up this week and today's show. We are moving next week on MarketWatchers Live to a 1-hour show versus 1.5. So I just want to make sure everybody's got that on their calendar. So we will be starting at noon Eastern, just like we do now, but we will be wrapping up at 1 o'clock instead of 1:30. It's going to give us an hour to pack all the good stuff in. So you're not going to want to miss MarketWatchers Live going forward. I also want to give a shout out to everyone who helped us this week with relative strength. It was a great week. Thank everybody on our production team and video team. Just a great job overall, everybody. But especially a shout out to Mark Chaikin, Gaddis Rose, Julius DeKempenaar, Arthur Hill, and of course today's special guest, David Keller. Also my wonderful co-host, Mary Ellen and Aaron Swinland. Great job to everybody. And really, if you haven't filled out that survey before, fill it out today, because this was a special week. I think the tremendous amount of free information that a lot of people came together to give you for this special week. And we'd love to get a little bit of feedback, see what it meant to you. If you didn't learn anything, that's fine. Tell us. You already knew it all. But if we did help you in some way, we'd love to hear that as well. But as always, Mary Ellen, it's great that you come on, because it's Friday, and because you do such a great job.
Happy Friday. Have a great weekend.
Yeah, absolutely. You too. And happy Friday and weekend to everybody out there. Of course, we wouldn't be able to do this without you. I want to thank all of you for being with us today and throughout Relative Strength Week. Please, please, please remember to complete that survey as you exit. It's located below your video player, and we'd love to get your feedback, especially this week. As a quick reminder, MarketWatchers Live airs 5 days a week, Mondays through Fridays, new time, noon to 1 o'clock p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe, and we will see you back here on Monday. Happy trading.